We continue to talk about this rotation, whether it continues or is strong or it's halted like it was the case today. Is it really a rotation, or is it more of a broadening of the market with more cyclicals and value stocks joining the rally? How do you position and allocate compared to tech?
Yes, we believe the market rally can continue from here, powered by all the positive vaccine news, more political clarity with a peaceful White House transition, and more stimulus to come. So we do expect market leadership to shift from top mega cap U.S. tech stocks to cyclical and global stocks. We are already seeing a strong rotation into cyclical and reopening trades with the vaccine news, and we expect this trend to continue.
How do you feel about cash, given that we still have so much uncertainty over infections rising around the world?
Yes, cash at this point, and also along with cash as high quality or U.S. government bonds, are likely to deliver negative real returns over the long term. We believe investors should take exposure to equities and other real assets to enhance potential returns.
So does it feel like we're stuck in a sort of an awkward position right now with just markets really wanting to believe in the vaccine euphoria, but still the reality is that we have to get through a Northern Hemisphere winter of subsequent waves of the virus first? So how do you best position to be able to deal with those push-pull tensions that you see every day?
Yes, we like to have our investor maintain a balanced portfolio. Investors are certainly cautious at this point as we await updates on the efficiency steps towards regulatory approval and the logistics of the vaccine rollout. So a balanced portfolio is a good way to go right now, and this is certainly a good time to look into global stocks as well and diversify into other sectors. So U.S. had a very strong run, and we believe particularly U.S. large caps will start to underperform in other markets at some point. Post-COVID recovery and corporate earnings will be stronger in more cyclically exposed U.K. markets, more favorable valuation in emerging markets. And we like Asia, particularly China's new digital economy, including e-commerce, food delivery apps, fintech services, and online entertainment platforms.
So you believe that the consumer story in China will continue to drive tech even as we continue to talk about this kind of nascent rotation into value?
Yes. COVID has accelerated many of the trends already in place when we enter what is set to be a decade of transformation. So it's important that investors complement cyclical exposure with secular growth. And what that means is that we still like tech, but also recommend to diversify and rebalance into other stocks linked to more normal things, which are value and cyclicals and post-COVID beneficiaries, such as 5G and sustainable investing. We also like areas with catch-up potential, including U.S. small caps and mid caps, financials, industrials, and energy.
In today's session here on Wall Street, we had electric vehicles losing ground. Tesla, Nikola, they had such a huge run-up this year already. Are we a little bit behind to get into those sustainable calls when it comes to clean energy?
We feel like sustainability and clean energy is going to be a big thing moving forward in this next decade. So we are at the very beginning of that, and some of these stocks are going to be very volatile in the beginning of this sustainability trend. So at this point, the incoming U.S. Biden administration will add momentum to the green agenda, and promoting sustainability will be a White House priority. And in general, green tech has come into sharper focus globally following pledges by both the EU and China to be carbon neutral by 2050 and 2060. So some of these battery electrical vehicle companies, we see a wide range of companies, not just electrical vehicles, but from battery power vehicles to renewable energy, that should benefit from a global transformation to become low carbon in the long term. So in the short term, we're not late, but there's going to be volatility.
Does 60-40 still make sense as the way a portfolio is balanced to you?
60-40, 60 equities, 40 bonds. At this point, we really see we don't prefer cash or bonds at this point, mainly because of the negative real returns over the long term. And bonds in general, U.S. government bonds, the Fed is anchoring short-term rates close to zero. We continue to expect only modest increases in the long-term interest rates, expecting rates to stay low even as the economy recovers. So we do like to have investors stay with equities and have exposure to either equities or other real assets to enhance the overall portfolio return.